Hi, folks. Best-selling author and certified tax specialist Navy Dowdy here. The quote of the day comes from the incomparable Yogi Berra. If you don't know where you're going, be careful because you might not get there. That's a yogiism. She's got a lot of them. Another way to look at that, remember Alice. Alice in Wonderland comes to the fork in the road and she says, I wonder which road should I take? Which way should I go? The Cheshire Cat appears up in the tree and says, well, where do you want to go? And Alice says, well, I don't know. And then what does the Cheshire Cat say? Well, then any road will take you there. Everything about planning for your retirement has got to start with the vision. Where do you want to go? Don't be like Alice. Having said that, here's my three coming financial tidal waves. As those of you that listen to this channel know, I sketched this out on a napkin, looking out the back window, looking at the waves crashing on the beach back in early 2016 at a conference in New Zealand. I was just thinking, this is what's coming, three financial tidal waves. This is going to be really, really bad. And back then it was a theory. Now, not so much of a theory. So I call this the ultimate financial tsunami. And it's the convergence of these three things. Just take a look, see if you think it's true. Obviously, rising interest rates and rising inflation are here. It's in the news every day. This is the big problem. Everybody talks about, this party or that party or, Putin or China or some politician or other or the companies. This is the problem. Distill it down to its essence. The problem is we have built an enormous bubble based on declining interest rates. The world's banks have made interest rates the lowest in the history of human civilization. Now think of that. If you look at my picture of my crystal ball here, you can see that between 1965 and 1982, interest rates went up tremendously. They hit the highest level in human history in 1982, October of 82, 18.1% for the U.S. 30-year Treasury bill. Now, that would have been a pretty fabulous investment, wouldn't it? You'd have earned 18% every single year since you bought that for 30 years. Then they would have been thrilled to cash it in and not have to pay that anymore. What happened to the markets? So when you evaluate your investments, I think you should look at them and how did they do the last time we had massively rising interest rates and massively rising inflation. That's the test, because along with those rising interest rates came commensurate inflation. In fact, in October of 82, the U.S. government official statistics were that we had 15% inflation. The World Bank estimated that it was really 18%. Notice exactly the same as the interest rates. And why is that? Well, a lot of reasons, but for one thing, if you lend your money out, you would expect to get more than the inflation. Otherwise, you're sliding backwards because the government then taxes you on those inflationary gains. So you earn 18%, let's just say, and then you have to pay tax on it. And if inflation went up 18%, you're sliding behind. You're 5 or 6% behind. So the interest rates should always be above the rate of inflation. That's part of the problem now, because how does the government, who now has an official debt of $31 trillion and rising fast, how do they pay the interest on the debt if the interest rates keep going up? So that's a really big problem. I used to tell people that I thought the biggest problem for people in retirement would be income tax. And I still think income tax is going to be really bad. It's one of the three financial tidal waves. However, that could easily get overtaken by inflation. What about rising interest? Seems like rising interest would be good, right? Well, everybody that I talk to brags about that they've got their investments set up in their retirement accounts 60-40, 50-50, 70-30. Well, what does that really mean? The 60% is in equities. Now, obviously, some equities do well with rising interest rates and inflation, and some don't. So you can't just say equities. You have to be a lot more specific. But let's talk about the 40%. What is the 40%? What does that really mean when they say 60-40? The 40% is in fixed income. Well, what's fixed income? That means bonds, mainly. Could be preferred stocks, but when people say fixed income, and I look at what they have been put into, it's bond funds. If you look at a bond fund, just pull up a graph. Here's a graph of the TLT, which is the 20-year bond fund. It's an ETF representing the 20-year bond fund. It's down 50% this year, almost. So that's not a safe haven. We have gotten used to thinking that 40% that we put in fixed income is a safe haven from stocks. And you can switch back and forth, of course, in your brokerage account. That was true in the years since 1982, when you had massively declining interest rates, until this year. Now, that's no longer true. When interest rates go up, bonds go down. Why is that? Well, it just makes sense. Let's say you could buy a bond and earn 4%, and a year later, the same company or the same government issues essentially the same bond, but they issue it at 5%. And so would somebody want to buy your bond and earn 4%, or would they rather buy a new one and earn 5%? Of course, they'd rather earn 5%. So that makes your bond worth less. This can be really, really dramatic. Let me give you a quick illustration of how dramatic that could be. If you wanted to go buy a 30-year treasury bond at, let's say, 2% interest, I'm going to guess, without getting my calculator out right now, that you would have to pay about $500,000 for that bond. 2% bond for 30 years, zero coupon, meaning that it doesn't pay anything along the way. It just pays off at the end. And let's just say it's 500,000. Well, what would you have to pay for that bond in 1982, in October of 82, when interest rates were 18.1%? You're going to be shocked to hear this. It's about $6,900. Do I mean to tell you that you could have bought $1 million bond, zero coupon, 18.1% for $6,900 in October of 82? Yes, that's exactly right. And again, I'm guessing at that number. I'll put the number up on the screen after this recording so you have the exact number. But the point is, it's a phenomenally dramatic difference. So does that mean that if you bought that bond today at $500,000, earning 2%, let's just say, and tomorrow the interest rates went up to 18.1, which they're not going to, but I hope they're not even over time. But if that happened, your bond would then be selling for about $6,900 in the marketplace. Phenomenal difference, right? That's what happens to bonds when interest rates go up. Think of it like a teeter-totter. Rising interest rates, bonds go down. Dropping interest rates, bonds go up. That's just the way it works. And we're talking about the existing bonds. Here's a little exercise. If you want to check this out, go down to the local library, go to the reference desk, ask them to get the microfiche for the bond pages for the Wall Street Journal back in October of 1982. I told this the other day to somebody, and he said, wow, microfiche, I haven't heard that word in forever. I think somebody someplace has probably digitized all of that, and you might be able to find the bond pages, but typically when you search for the numbers, they don't go back that far. if you could find what is somebody selling the existing 30-year treasury bond for in October of 1982, in an old one that had been issued, 5-6 years before that, you'll find them selling for 35, 40, 45 cents on the dollar. And that's what happens to bonds. It's just a normal thing. Everybody knows that deals with bonds. So is it a safe haven? There are other alternatives that you can use. And maybe if you want to get on a call with me, I can show you that. But just don't think that while inflation is rising and interest rates are rising, that 40% is a safe place to put the money. You can go to, now, one choice, here's a simple choice, just put it in a money market. And you might say, well, then I won't earn anything. True, you aren't earning much in money markets now, but the rates are going up, and you will earn more if the rates keep going up. And if it's a government money market, at least the money will be safe. We can talk about these three tidal waves that are coming forever, but that gives you an overview. That is the problem. You must deal with this problem, or it's going to destroy your retirement. So, folks, that's the problem. That's the issue that is facing 78 million baby boomers going into retirement, and many of you already in retirement. So it wouldn't be very nice of me to give you a problem without a solution. So here's my solution for you. It's called my on-tax family wealth, and the process that I've invented over the last 40 years called the Smiling Retiree process. I put this together to help many people I've helped going into and through retirement over the last 40 plus years, and it consists of three major categories. The foundation, what are the problems, and then lastly the solutions. 3 categories. It covers everything from the foundation, like the vision, where do we want to go? I had a pilot ask me the other day, well, what's it going to cost to work with you? And I said, well, that's kind of like saying, well, what's the trip going to cost? You kind of need to know where you're going. Are you going down the block, or are you going to, some long trip into the South Pacific, and you're going to stay there for 6 months? You got to know. You got to have the vision of where you're going. What are the obstacles? The obstacles I put in this process, the biggest two are taxes and inflation. Market losses, of course, this year have been huge for a lot of people. That certainly would be part of it. And then lastly, what are the strategies? Countless strategies. There's so many. In my on-tax family wealth process, I go over those with people, which ones might be appropriate for them. So here's a challenge I would have for you. If you can find a better process, use that. I don't think you can. I've developed this over a very long time and perfected it for a lot of people, but maybe you can find something better. If you can find it, use it. Do me a favor, though. Call me and tell me what it is. I'll use it if it's better, if it really is better. I don't think you can find a better process, but I'm open to any new idea. I learn something new all the time, so I don't have every single answer, but this is a pretty well-honed process. If you go through this process, it'll give you, I believe, the best chance for a good, secure retirement. If you want to know more about this and how this might fit you, if it would, then click the link below, get on a short call with me, and we'll find out. And if you like these videos, subscribe. There's over 200 tax tips in this one channel alone. So even if you don't qualify to be in my on tax family wealth family office, there's still a lot of information on here that would be really great for you if you want to save taxes, for instance. So I'm Navy Dowdy, and remember, financial fitness can be beneficial to your wealth.